Welcome to S&P Capital IQ's monthly loan market update. I'm Ruth McGavin, a member of the Leverage Commentary and Data team. Over the next few minutes, I'm going to talk through some of the trends at work in the European leveraged loan market during the first quarter of 2014. In focus is the imbalance created by thin supply and vigorous demand for assets, which is causing conditions in the market to become increasingly issuer-friendly. New issue loan volume in the first quarter was pretty disappointing, at 14.6 billion euros compared with 16 billion this time last year. A big block came from a single deal, which was the M&A financing for cable operator Ziggo, which brought 3.7 billion euros to the market. But overall, M&A related deal flow was much thinner than had been hoped. The first quarter's deals did include the first covenant-lite transaction to be syndicated purely in the European market since 2007, in the form of Santé Animale. More cov-lite issuance is expected in the coming months after this deal. On the demand side of the ledger, there are many hungry mouths to feed. CLO issuance picked up from a slow start to reach 2.5 billion euros in the first quarter, and at this rate the CLO market is well on track to beat last year's total issuance volume of 7.4 billion euros. In addition, non-CLO money, much of which comes from pension funds from around the world, continues to chase European senior term loans as an attractive source of yield in the current low interest rate environment. As a result of the supply-demand imbalance, the cost of borrowing in the European loan market fell. Clearing yields on European institutional new issuance trimmed to 4.55% in the first quarter, making a new record quarterly low. This was down from 4.73% in the fourth quarter. Within this, cross-border deals were once again cheaper than the domestic deals by about 14 basis points. Leverage multiples rose, meanwhile, also reflecting the heated demand for assets. For sponsor-backed buyouts, average total debt to EBITDA reached 5.6 times, up from 4.6 times in 2013 full year. 40% of buyouts carried leverage of 6 times or higher, which is on a par with 2006. Despite the hot market conditions, the S&P European Leveraged Loan Index managed a gain of only 0.41% in the first quarter, held back by a 0.72% market value loss. The index performance was dragged down by a handful of stressed and distressed credits, including French retailer Vivate, that traded off during the quarter. The rolling 12-month early default rate ended the quarter at about 4.4% by par amount, which is up from 2.9% at the end of 2013. At the close of March and moving into the second quarter, the loan market definitely felt more lively in terms of new issuance, with a mix of new buyouts and opportunistic refinancing and repricing activity coming over the horizon. The one to watch is Numericable, which has lined up a huge cov-lite M&A financing to back its bid for SFR. The deal will also be syndicated across the US and Europe and will certainly soak up some liquidity. However, absent a really emphatic run of new issuance, the technical bid for loans is expected to stay strong. This brings me to the end of the market review. If you're interested in finding out more about the loan market, please take a look at our website, or you can find us on LinkedIn, Facebook and Twitter. The links for each are listed in the description below. You can also download this presentation at slideshare.net. Thanks very much for listening. Join us again next time.